Welcome to Money Matters with financial advisor Russ Story of Story Wealth Management Group. With over 20 years of advising clients, Russ has some ideas to share with you based on biblical principles, financial strategies from a Christian perspective. It all starts now. Here's your host, Russ Story.
This is Russ Story with Money Matters here because money matters. My name is Russ Story. I've been doing that financial practitioner. I'm a financial professional, financial advisor. We've been doing this for about 25 years. And in today's show, we're going to talk about a lot of different things. We got quite a few topics to talk about. We're really excited about them. I think we're going to have a good show. So, again, to clear the air, let you know who you're dealing with. My name is Russ Story. I've been a professional financial advisor practitioner now for about 25 years. We've been based in Douglas, Georgia for a long time. We deal with folks every day. We sit down and we talk to folks and we try to solve tough financial problems. And we talk about an awful lot of stuff here on this program. We talk about stocks, bonds, mutual funds, insurance, annuities. We talk about what they are. We talk about how they can help you and some pitfalls and some potholes to try and avoid. Today's show, again, if you want to communicate with us, that'd be great. We get an awful lot of emails. Keep the cards and letters coming. You can email me at rstory@storywealth.com. You can also give me a call at 877-240-9787 and set up an appointment. If you've got an account somewhere, if you've got an investment account and you're a little bit concerned about it, we want to offer a second opinion. A lot of times we can take a look and maybe be of some help. If we can't help you, we'll be glad to tell you. But we get that request a good bit, and I think it's healthy. It never hurts to have a second opinion when it's serious money. Serious money is defined by me as my money. I feel like you probably look at it the same way. So any amount of money, if it's my money, it's serious money to me, and I'm sure you feel the same way. First of all, we got a lot of stuff going on. The stock market has done very well. A lot of people are asking questions about, if the stock market is going to go down. Is it going to fall for a while? I mean, it's gone up now for a long time. We've had 9 years of very attractive gains. I mean, the stock market hadn't gone down as defined by a bull market now in 9 years. On average, it takes every 3.5 years, it's going to take a breather. So we're going to talk a little bit about that. Some people have asked me about the tax situation where Trump's trying to put through a tax proposal that's going to cut taxes. A lot of people criticize it because they say it's going to cut taxes on the rich. But the reality is we believe it's going to be very helpful to the markets. We think that it'll be a positive thing if he's able to get his tax cuts, if he can get them through. So we think the stock market will respond favorably. We believe that the markets will continue to do well, especially if he can get some of these tax cuts pushed through. A lot of people have asked me about, what the stock market's going to do as far as, I made a prediction a while back before the first of the year. I said that the stock market would hit 24,000 before the end of the year. Now, that's a little bit aggressive, perhaps, but, of course, when I made that statement, we were a long way. But we've gone up and gone back a little bit, but I think ultimately it's gonna do well, and we should be able to see that 24,000. Well, Russ, you don't know. No, I don't. But I really wouldn't be surprised. I don't really look for a pullback in the next little while, hopefully. We really don't see anything on the horizon. We know that valuations are stretched a bit. And when we say that, price-to-earnings ratios and the things that most analysts look at to determine whether stocks are up or not, they're kind of high. But we believe that what we say multiples will continue to expand in this type of thing. I want to mention right now that we are having a webinar. It's kind of like a seminar, but you're in front of your own computer or laptop. And we're going to discuss sequence of returns. And I'm going to touch on that just a little bit today because sequence of return, I believe, is or average annualized rate of return, more specifically, is a term that I believe is the investment industry's big lie. I believe that you need to understand the difference. You need to understand the importance. You need to understand why there's a difference, and I think you need to be informed when you go sit down with somebody and they're a financial advisor, or they're a broker, or they're with a big investment firm. I think these terms, I think it'll help you when you're dealing with them if you understand what they mean, what they really mean, and not just what you maybe perceive them to mean initially, because I think that's sort of the deal. But I think once I can explain to you some things and some differences in the mathematics, that in this webinar, I think we're set up to do a pretty good job at that, illustrating it. And I think you'll become a more informed consumer, and that's a good thing. That the sequence of return, the average annualized rate of return, the sequence of return webinar is going to be held May the 9th at 5 o'clock in the afternoon. Now, we're doing it at 5 o'clock because I know some people will just want to stay late and look at it on their computer at work maybe, and that may or may not work out for you, but we're going to try it May the 9th at 5 o'clock. Now, you'll need to go in and sign up for this. Go to storywealth.com, and just sign up for the webinar and just follow the instructions. It's pretty easy to find. So storywealth.com, and you can sign up and join us in this webinar. Special announcement. Last week, we awarded the Administrative Professional Assistant Award. We recognized Ms. Brittany Little, and she works at Jared L. Roberts Attorney at Law in Douglas, Georgia. She received flowers, a gift certificate for a weekend at St. Simon's Island. She got a manicure and a pedicure. She got numerous recommendations, and she was nominated by her coworkers. So congratulations to you, Brittany. It was a pleasure and an honor to be able to go by and present you with your gifts and your award. So that was an honor. Also, want to mention Kevin Sears. Can't leave him out. Kevin received. We had sort of two things that kind of ran together as far as our recognition and awards are concerned. We gave Husband Appreciation Award. Now, that was actually last month, but we got an awful lot of nominations, and he was nominated by his wife, and he received a brand new Weber grill, and I hope he'll put that to use and maybe have me over and cook me a big steak on it. What do you think, Kevin? He'd probably be up for that. He's a great guy. So congratulations to you, Kevin. And again, thanks for participating. Thanks for nominating folks. We appreciate you being a participant with these programs that we're having at Story Wealth. We're going to continue to do these because we, first of all, we enjoy doing them. And second of all, we think there's a lot of folks out there that need to be recognized and let them know that they're appreciated. So it's a lot of fun doing it. So before we get into the meat and potatoes of today, I'm going to take a break. We'll be right back after these messages.
You're listening to Money Matters with financial advisor Russ Story of Story Wealth Management Group, where their purpose is to help guide clients in making the right decisions for their financial future. Russ Story began investing in the stock market through a class in high school over 30 years ago. He spent several years in Atlanta as a vice president with Buckhead Financial Corporation, and now he operates the Story Wealth Management Group based out of Douglas, Georgia. He has lectured at the University of Georgia on issues of retirement planning and financial issues, and taught investment classes at South Georgia State College. His titles and designations include financial advisor, registered financial consultant, and investment advisor representative. For more information, remember this website, storywealth.com. That's storywealth.com. And now for part 2 of Money Matters, here's your host, Russ Story.
Okay, this is Russ Story back with you. Money Matters here on the radio. We're thankful you're with us today. We appreciate it. We hope everybody's had a good week. We hope everybody's had a pleasant work week. I know you're looking forward to the weekend. Hopefully you're going to have a good, happy, safe, fun-filled weekend. If you're like me, I kind of like to go and fish. If you're like me, I also hang out and play with some musicians sometimes. I'm in a band, and that's a lot of fun. That's something that we all enjoy, and get together. Some of my old rock and roll buddies, and we'll get together and we'll play the guitar and play the drums a little bit. We have a good time with that. Russ Story, I'm your host for Money Matters. It's awful nice to be with you. Just to tell you a little bit about what I do. For the last 25 years, I've been a investment advisor. I have been a professional financial advisor. We meet with folks every day talking about their issues, problems, trying to help them work through different things. There's never a dull moment. I've had 25 years of very happy times. I've enjoyed my work very, very much. It's very gratifying, and no day is the same. I have something different coming along every day. So it's always a challenge. But what I'm talking about here on the radio with you are things that typically come up, are things that I talk about with my clients, my beloved clients, every day. And hopefully you'll glean something from this program, and it'll help you. Hopefully help you and your family, you or your family, and I hope you can take something away from this that's positive and helpful. Now, I would like to tell you, if you hear something on this radio show that you think makes sense to you, if you hear something on the radio show, then you go, hey, you know what? I need to try to use that. That sounds good. I like that, Russ. I'm gonna go do that. I'd encourage you to go to whomever your professional advisor is, your financial advisor, and talk to them about what we discussed here on the radio, and then go and talk to them and make sure that it's right for you. I'd encourage you to do that before you try to employ any of the strategies or products or anything that we talk about on the radio here today. So anyway, tax cuts, we talked a little bit about that. I do believe that it's important. If Trump gets his way on the tax cuts, I'm pretty confident that we'll continue on our march and hopefully hit that 24,000 mark. If we do, we'll have a big shrimp bowl or something, but hopefully we'll hit my 24,000 mark. One of the things that I do know is that I don't know. And while, Warren Buffett used to talk about, and I think he's a brilliant man. He's a very wealthy man, but he always talked about, when it comes to investing, when everyone else is greedy, you should be fearful. And when everybody else is fearful, then you should be greedy. And I understand what he means by that. When everybody thinks that it's all roses and sunshine, that's when everybody's fully invested, basically, and the market typically has a strong tendency to go down. We're overdue for a sell-off. I'll say that. We've had bear markets typically every 3.5 years. They come around since 1929. And right now, as I sit here today and talking to you, we've had about 9 years since the market has actually gone down for any significant amount. So we're definitely overdue for a stock market downturn. I talked a little bit about Social Security last week. I talked about that, and I got some emails on that. Thank you very much. I was encouraged. There's a little more to it. I mentioned last time that the longer you can put it off, typically it makes sense as far as drawing your Social Security retirement benefit. That's not always the case. So there's exceptions to things that I say many times on the radio. I have a tendency to make generalizations. And again, that's one of the reasons why I'd encourage you not to employ some of the things I talk about right away. So without talking to a financial advisor professional, because everybody's situation can be a little bit different. Typically putting off the Social Security, you're going to increase your benefit by 7-8% or so. And that's a good thing. Anytime you can increase your retirement account or your investments or your income and increase that year over year by 8%, that's a pretty attractive deal. So we, as a general rule, we do try to encourage people to put it off as long as they can. One of the things that I want to talk about, Jeremy Siegel he's a Wharton School. He's at Penn up there, and he's well renowned. He is a professional. He is a professor, and he gets an awful lot of airtime. A lot of people give him a lot of credibility. He has, predicted the market's going to 20,000, and that was right. But he wasn't the only one that said it would hit 20,000. I mean, I did too. There's a lot of people that did. I mean, for what that's worth, we look at our economy, and a lot of people say, well, how in the world when I started doing this business, the market was at about 3,200. And today it's over 20,000. So how can it go to 3,200? I don't understand. What goes up must come down and all that. Well, it doesn't necessarily apply when it comes to investing. And it makes sense sometimes to stand back and not use these kind of cliches when it comes to facts. I mean, our economy has expanded, the U.S. economy. We have to expand our economy for several reasons. Number one, we need to increase our tax base so that government can provide services to a growing number of people. The second reason why the stock market has expanded is because that our economy has expanded. There's more people. An easy way, I had a guy explain it to me. He's a lot smarter than I am. Said, there's more people eating McDonald's hamburgers today than there were 15 years ago. There's more people drinking bottled water than there were 15 years ago. There's more people. So you see the point. I mean, so as our economy expands, and one of the things that Trump's talking about is by reducing taxes, we're going to put more money to work to expand and grow the economy. Consequently, or ironically, by cutting taxes, we should increase our revenue down the road. I hope that's true. I do believe it will stimulate the economy, and I think it's not a bad thing for the private sector for sure. A couple of things I want to mention about Jeremy Siegel. He was talking the other day, and you guys may have seen this. He said, the ultimate hedge against the stock market is the 30-year Treasury, basically, was what he was saying. He said that the 30-year U.S. government bond was the perfect hedge against the stock market collapse. Now, right now, the 30-year bond is yielding right at 3%. I think 3.01% is what it's yielding currently. Now, that's a 30-year maturity U.S. government bond paying 3%. And this is a quote. And don't forget, the long bond is the ultimate hedge against the stock market crash. If there's going to be a bad event internationally, North Korea, Europe, or whatever, everyone runs to the long bond, the University of Pennsylvania economist and professor of finance at the Wharton School of Business told CNBC during a Monday interview. Quote, it's an insurance policy. It gives the bond a premium, and a premium means a low yield on that instrument, he said. Quote, if something happens, they'll go up if the stock market goes down 500 points. Jeremy Siegel, I'm sure he's a lot smarter than I am, but there's so many things that I think are bizarre about that statement, and I just want to cover it because I think it's quite dangerous, I think, for the average investor to take that and to think that it makes sense at this point in time to go. I disagree with some of what he's saying, okay, and I know that's laughable that old Russ is disagreeing with this guy at the Wharton School of Economics. But let me share with you what he's talking about. First of all, I want to just ask you, do you think it makes sense to loan the government and to have an agreement where you have 30 years until it matures? I'm going to tie my money up for 30 years. First of all, that's a long time, 30 years. But also, not only am I going to loan them 30 years, I'm going to go, okay, government, you're giving me such a good deal on interest rates. Man, you're paying me 3%. 3% for tying the money up for 30 years. How many folks, raise your hand, but don't take your hand off the, steering wheel. You can do it, silently. How many folks think loaning the government for 30 years before you get your money back, making them a loan at 3% for 30 years makes sense? I don't. That's terrible. I mean, I'm not going to loan the government my money for 3%. And here's something else worse than that. Interest rates are at a low point, I believe, and most everybody believes that. I don't know where, Mr. Jeremy Siegel sees things, but we're really coming at the tail end of a 35-year bond bull market where interest rates have come down. Consequently, the value of bonds has been able to stay up pretty high if somebody wanted to sell them. Let me tell you what, you buy a 30-year bond, in 5 years, if interest rates are low or higher than they are now, your value in that bond, if you had to have an emergency liquidation situation, is going to get crushed. The other thing is, if the stock market goes down, I'm not so sure that the money's going to rush over to the Treasury, paying a 30-year Treasury, maybe 10-year might be, conceivable. But a 30-year bond, I just have a hard time believing that that's going to be driven up in value. So I'm not sure. Again, I'm sure he's a lot smarter than I am. But what I do know, and what I've learned over 25 years, is that as interest rates rise, bond values go down on the long bond. So I really have a problem with that. I think there are other ways to build a firewall or create a hedge for yourself in the event of a declining market, but I don't know if buying a bunch of 30-year treasuries at 3% makes a whole lot of sense. So that's my 2 cents. You've heard it, okay? So thanks for listening to Money Matters. No, I'm kidding. So I'm almost done here, but
You're listening to Money Matters with financial advisor Russ Story of Story Wealth Management Group. You know, financial security is more than just a balanced budget. It's about knowing that you're prepared to face the worst in life and that you're ready to take advantage of the best. This type of security can require a highly individualized approach to financial planning and investment management. Story Wealth Management Group is committed to providing just that, focusing on both the numbers and the people by making your unique personal aspirations a cornerstone for your tailored solutions. For more information, remember this website, storywealth.com. That's storywealth.com. Or call the office directly at 912-384-0030. That's 912-384-0030. And now for part 3 of Money Matters, here's your host, Russ Story.
a few things we're going to talk about at the next webinar. I just want to mention, we're going to talk about sequence of return. We're going to talk about average annualized rate of return in this next one. But sequence of return, you know, it's pretty amazing to me what the numbers look like. And I'm just going to give you a little snippet. A lot of folks will say, well, you know, Russ, the stock market's done so well, and, you know, all we got to do is just invest and forget it. Well, one of the things you'll remember about Story Wealth is we believe in buy, hold, and sell, not buy, hold, and forget. We believe there's a time out there where we have to manage risk. And you go, well, you know, that's a big, you know what, you know, all I got to do, I got a broker that says we don't want to market time. I got a broker that tells me we just want to make sure that we have time in the market. And I can sell you on that. I can explain to you why that's a good idea. Now, I don't necessarily believe that it's true. In fact, I don't. But, you know, you invest in the stock market. Let's say 1961 through 71, that 10-year period, you'd have made 11.4%. From 64 to 74, you'd have made 4%. And from 76 to 86, you made 21%. Now, let's say that you were a worker and you retired in 61. And you invested all your money in the stock market, you made 11%. 3 years later, you invested, you retired from the same company, had the same amount of money, you'd have made 4%. That's 11 versus 4. Now, are you the guy who made 11? Is he just, you know, twice as smart as the guy who retired 3 years later? That's ridiculous. Of course not. He was just fortunate. So there has to be some ways, and I believe that there are, that we can manage and try to manage the risk of the volatility and the way that the sequence of return, if you will, as the stock market provides us return and as it goes up and goes down. So there's a lot of smart folks out there. Institutions have been doing this a long time. And one of the things that we're determined to do at Story Wealth is to make sure that our clients are or have the information so that you can make the right decision to determine whether or not you need to try and manage some of this risk or not. Give you an idea, a lot of people say you retire, and let's say that I have an investment here that has an average annualized rate of return of 6%. And let's say you take $100,000. Well, the way we think about 6% would be I invest $100,000. And then I make $6,000, so that's $500 a month. So I draw my $500 a month. My money's in the investment. At the end of the year, let's see, I put in $100. I took out $6,000. I made $6,000. So at the end of the year, I'm at 100,000, right? I mean, that's the way we look at it. Well, if it was a CD or perhaps a 10-year bond that was paying 6%, then that's right. We would draw a consistent and a regular interest every month or every 6 months or however it paid. But you'd end up with the same amount you started with. But let me share with you this problem. Let's say that you invested in 2007 and you roll the money into, or maybe you just call Fidelity up and you said, hey guys, I'm rolling my 401k. And they go, okay, well, all you need to do is roll it to an IRA and then we'll start sending you out a monthly check. That's what I hear sometimes. I believe that's terrible advice, by the way. So what they'll do is they'll go in here. Let's say that we have a negative 30%, negative 20% the second year. And these are our returns. We got 10%. Years 3 through 8, and then year 9 and 10, we make 20 and make 30 in year 10. So we lost on the front end, but we did well in the middle, and we kind of made up for it, right? Now, if you add those up and divide them by 10, you'll come up with a 6% average annualized rate of return. The problem is, because you lost up front, you lost big in the first year and the second year, you're down $6,000, and you draw out your $6,000. Now, all of a sudden, that $100,000 at the end of the first year is worth $64. At the end of the second year, it's worth $45. And it played catch up, but at the end, although you continue to draw the $6,000, and remember, the math makes sense, right? I mean, 6%, if it averages 6%, everything ought to work out, right? Well, the problem is the sequence of return. The problem is not in just what your average annualized rate of return was, but it matters about how you got that return and on what. So the ending value in that situation was $38,898 in that example. Well, wait a minute. I averaged 6%. Yeah. Do you see how important this can be? Do you see why I talk about the 5 years before retirement and the 5 years into retirement? I talk about those 5 years going into retirement, or what we call our retirement red zone. Prudential talks about that. I think it's a great analogy. We're at the 20-yard line and we're trying to get it across a goal. You don't need to lose money within the 5 years before you retire. Look, I believe that the decisions that you make during that period of time, the 5 years before you retire and the 5 years after you retire, are probably really and truly some of the most important financial decisions you'll make in your life. And this type of information you need to know. Now, let's flip it on the other side. Let's say we made big on the first 2 years and we lost in year 9 and 10. Remember, we're taking $6,000 a year, start with $100,000. First year we made 30. Second year we made 20 and 30 in years 9 and 10. Well, now you're at 105. You mean to tell me that the difference between being lucky up front and lucky in the back is $5,500 roughly? You think that's what you want to take that kind of risk to perhaps end up losing 60% of your money in a situation that could occur? So it depends on how you get the 6%. When you go sit down with a financial advisor or some of these brokers, they're not talking about a linear rate of return like you and I think about when it comes to, say, a CD rate of return. So I think it's important that you understand that. Now, I'm going to take a real-life example, and I'm going to hit you with this one. Here's a real-life example. In 99, this thing made 291%. What was going on in 99? You remember the dot-com bubble we had? You remember that? Okay, so in 1999, this particular investment, this real life example, made 291% in 1999. In 2000, it lost 20. In 2001, it lost 59, and in 2002. So if you look at those 3 years there, okay, you're up 291. Holy mackerel! That was when the stock market, everybody was buying internet stocks. Okay, so that's what we're talking about. So 100,000 went to 391,000. In 2000, because it lost 20, you're at 309. And by 2001, it lost 59.70. So now you're at 124. Okay. So by the end of, I'm showing 12 of 02, it lost another 59%, and you were down $50,000. So your 100,000 lost half of its value. But let's look at what they would tell you was your average annualized rate of return on this investment. Let's say you go down and the broker, the financial advisor you're talking to, he says, well, look, I got a great investment here. This investment's had a yearly average annualized rate of return of 37.66%. You go, wow, man, that's incredible. Yeah, we need to put you in this. Okay, well, I'll buy some. I like that. But the real story is you lost half your money. Well, how can that be? How can those things? How can you how can you rectify those? What would you just say? Well, all right, let's work through the numbers. We had 291.15% of total gains during that period of time. You had 140.50% losses. So the net gain was 150% divided by the time that we held it. It was 37.66%. So the average 4-year period, you made 37.66%. That's what they sell you on. But the reality is you lost half your value. Now, I don't know about you, but I don't need that kind of thing. And if you got in the year after it did so well, your money would have gone from $100,000 to about $12,700. So I don't know about you. But I think that what I've proven here, hopefully, by the math. Now, look, I admit this is an extreme example, perhaps. These were extreme times back in 99, 2000, 2001. I understand that. But you cannot deny the reality of the principle. So I want to encourage you, don't just accept average annualized rate of return as being like a linear rate of return, whereby you can put your money in, you can draw money out, and everything's going to be okay. Because let me tell you what, after 25 years of doing this work, after meeting with folks day in, day out, you have no idea how many times I've sat here and talked to folks, and they've told me about how that financial advisor down the street told them what a wonderful investment this was, and that it had averaged 11 and 12% a year, and they were drawing 6, and everything was going to be okay, and guess what? Everything wasn't okay. So I'd encourage you, when it comes to your investments, does your financial advisor currently understand about sequence of return? Do they understand the difference between an average annualized rate of return and a linear rate of return? I don't know. I hope that they do. But if you'd like to double check, you'd like a second opinion, we're always available. Give us a call. We're always available. 912-384-0030. You can give us a call. The 800 number is 877-240-9787. You can certainly give us an email. Send me an email at rstory@storywealth.com, or look us up on the web, storywealth.com. Take a minute, put it on your calendar. Join us for the webinar we're going to have. We got 2 or 3 of them on there, I think, and you can sign up for that. We also announced some other things lately. We're going to be granting a scholarship starting in 2018. We're really excited about that. We think that's a great thing, because there's a lot of things in this world that are good, but we know a few things that can change people's lives more than education. We don't know of many. So anyway, it's been a pleasure being with you today. I may have run over time a bit, but as always, it's a pleasure. I hope you have a good, safe weekend. I hope you have a big time this weekend. Hopefully you've got a little jingle in your pocket and you're going to be able to go out and do some things you want to do. Give us a call, and God bless you, and have a great weekend.
And that's another edition of Money Matters with financial advisor Russ Story of Story Wealth Management Group. Find more information on this website, storywealth.com. That's storywealth.com. Feel free to email your questions and comments to Russ at this email address, rstory@storywealth.com. The email, rstory@storywealth.com. And finally, here's the phone number to call right into the office of Story Wealth Management Group, 912-384-0030. That's 912-384-0030. Story Wealth Management Group is an independent firm with securities offered through Summit Brokerage Services Incorporated, member FINRA SIPC. Advisory services offered through Summit Financial Group Incorporated, a registered investment advisor. Investing involves risk, as you may incur a profit or a loss. Please carefully consider investment objectives, risk, charges, and expenses before investing. Past performance cannot guarantee future results. Summit Brokerage Services, LLC, and Story Wealth Management Group do not provide legal or tax advice. For services of legal or tax advice, please seek the services of a qualified professional.